Good morning, everyone, and actually good afternoon wherever you are. And thank you for joining us for this edition of our monthly educational webinar brought to you by the Entrust Group. My name is Munzer Ghosheh. I'll be your presenter for today's webinar titled Tips from Savvy Investors. Actually, this is what we see our investors do and what to do before tax deadline. With the tax season looming on the horizon, we thought it might be the opportune time to discuss with you a different topic today in our webinar, such as tax deadlines and what it could mean to your retirement plan, etc. Now, I know you will have some questions, and I encourage you to ask them, and I'll be very happy to try to respond to them all. But please keep in mind that we're just administrators at the Entrust Group, and we don't give any sort of advice, including tax advice, and to please consult with your tax advisor for your specific needs and goals. But having said that, please go ahead and type in your questions, as you can see in the bottom left-hand corner of the chat box, and we'll get to them at the end of the presentation, time permitting. So with each webinar, we start with our disclaimer that we're required to actually read out loud to you. So the Entrust Group, Entrust, does not provide investment advice or endorse any products. All the information and materials are for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment, and we actually recommend that you do. So a little bit about the Entrust Group. For those of our listeners out there who are not familiar with us, we are the premier administrator for self-directed retirement plans. We work with individuals and small business owners who wish to invest in non-traditional assets such as real estate, notes, private placements, precious metals, and other alternative investments with their IRAs or 401k plans. As I mentioned in the inception, we do not give any sort of advice or sell any products. We're merely the administrators to your self-directed IRAs, and we're just order takers, if you will, for our clients. We are the leader in our industry. We've been in business actually for over about 34 years. We celebrated that earlier this year, later last year, and we have about close to $3 billion in investor assets. But what really makes us unique is that we are the pioneer when it comes to education in our industry. We offer national continuing education programs for professionals such as realtors, CPAs, attorneys. We also offer the national and local in-person events and webinars such as this one. We're also the only ones in our industry that have local offices, which to better serve our clients' needs and provide them with the best customer service that they desire. So a little bit about our agenda for today. It's, again, as I mentioned, it's a bit different than most of the webinars we usually do. We typically are discussing with you, self-directed retirement plans and how they pertain to alternative investments such as real estate or private placements, show you how it's done, and so on. What we'd like to talk about today is what might be on the minds of many of you, of our listeners out there, and that is, tax deadline. I mean, it's coming up, and what it means in particular to IRAs. We'll talk about tips on how to maximize your tax refund. We also talk about contribution basics, eligibilities, what are the deadlines to each type of retirement plan, limits, etc. Maybe touch up a bit about how to get started in a self-directed IRA and how simple and easy the process is, and then open it up for some Q&A for our listeners out there. So tax deadline and what it means for IRAs. One thing you'll first notice, and it's in red right there, is the tax deadline for 2016. We're always used to April 15th, right? This year is actually April 18th, not the 15th. And we can probably thank, Washington, D.C. for those 3 extra days. The state capitol celebrates actually a federal holiday on the 15th. So the deadline for this year was extended to Monday, April 18th, since the federal offices are closed on the 15th. So actually what that gives us is a chance to, I guess, procrastinate a couple more days to file our taxes. So it is tax season, and that also means it's IRA season, IRA season. The deadline to put away savings in a 2016 IRA account is the same day your 2016 tax return is due, no extensions. So here's your possibility to grow your investment earnings, whether it's on a tax-deferred basis if you have a traditional IRA, or for a Roth IRA, which is funded with after-tax dollars. It grows tax-free, and then when you take the money out, it comes out as tax-free. Every plan, has its own rules and regulations. We'll talk about those in just a minute, dictating the limits and contributions you may deduct, if any. Again, contributions may be deductible. It depends on a couple factors that we will discuss shortly. So tips to maximize your tax return. And again, I think the first step in maximizing your tax return, in my opinion, begins with knowing what your tax bracket is. By knowing how much income you are expected to make in that year, you can better determine how many and what types of tax limiting moves you need to make before the end of the year. Secondly, look to make a charitable gift to a qualified nonprofit of your choice. Depending on your income situation, you may be able to deduct, charitable gifts of up to as much as 50%, I believe, of your adjusted gross income. Again, for specifics and for your needs, consult with your professional, please, about different options there and so on. Thirdly, take advantage of what we call a flexible spending account, better known as FSA. The key where FSA contributions are concerned is to not put more than in your account than you would spend on medical expenses for that year. In other words, this is a type of plan that it's a use it or lose it kind of plan. So the FSA funds for a current year cannot be rolled over for the next year. So you want to make sure that you have in there, enough, otherwise you lose it. Take advantage of a health savings account. Not many people take advantage of that, and it's actually another tax advantage plan for individuals who are enrolled in a high deductible health plan at work. And you can use those funds for any medical expenses, for instance, prescriptions, eye care, etc. The funds you contribute to your HSA are tax deductible, therefore they're reducing your taxable income. And one of the many main advantages of an HSA, unlike the FSA that we just talked about, is that you don't have to use your contributions in any particular year. So it's not a use it or lose it type of plan. The funds kind of continue to accumulate until you need them. So again, take advantage of that and look to maximize your tax refund by putting away some tax deferred dollars in an HSA. Again, talk to your CPA about that and see if you're eligible as well. And lastly, the most important one, make the maximum contribution allowed in your plan. Typically the more you contribute, the less the taxable income you may have to claim. So not only are you investing in your future when you open a retirement plan, but contributing to your IRA may actually increase your tax refund depending on your income and marital status and so on. So let's take a look at an overview of the individual retirement plans that are out there. Individual retirement plans arrangements, better known as IRAs, it's basically essentially an account you set up at a financial institution that allows you to save for retirement with tax-free growth or on a tax-deferred basis, depending on what type of IRA you establish. The two most popular types of IRAs out there are traditional IRA or a Roth IRA. With a Roth IRA, you make contributions with after-tax dollars, and your money will grow tax-free with tax-free withdrawals, provided you are over a certain age, typically the distribution age of 59 and a half, and the Roth IRA has been established for a number of years, typically 5 years. So if you have those, you meet those two criteria, you're eligible for that qualified distribution of tax-free withdrawals. With the Roth, there is no required minimum distributions as there is in the traditional, which we'll talk about in just a second. With the traditional IRA, your contributions are made with money you may be able to deduct, and I say may because it's going to depend on your income and other factors. And any earnings you will grow will be tax deferred. So you will eventually, pay the taxes when you withdraw them when you retire. Presumably, we're assuming that you are at a lower tax bracket there. Required minimum distributions, better known as RMDs, begin at the age of 70 and a half in a traditional IRA. As we mentioned, in a Roth IRA, there are no required minimum distributions because you've already paid the taxes, but on a traditional IRA, one of the factors are that you have to start making required minimum distributions at the age of 70 and a half. So let's talk about Roth IRAs first, and are you eligible? Am I eligible to set up a Roth IRA? And that's a question we always get. And again, ultimately the question should be to your your CPA or tax advisor that knows exactly what your income are and is familiar with your tax bracket and so on. But the requirements generally to contribute to a Roth IRA are simple. No age limit. You can be of any age, but you must have earned income. Taxable compensation is required. The limits to how much you may contribute to your Roth IRA, however, will depend on your modified adjusted gross income. It must be within certain limits for a full contribution. Otherwise, it phases out, and then if you're making a certain amount or higher, you're really not eligible to set up a Roth IRA. You could set up a spousal Roth IRA, and those are very few of people out there have heard of a spousal IRA. It's basically if you're married, you're filing a joint tax return, and your spouse, husband or wife, is not working, does not mean that they cannot have their own retirement plan. So by filing a joint return, you could actually contribute to their IRA and calling it a spousal IRA. So contributions are made to their own IRA here. Again, look for that. In this way, you can again maximize the amount of contributions you're making to your IRAs. Take a look at here's a snapshot of the modified adjusted gross income table eligibility. It kind of shows you, for instance, if you are married and filing a joint tax return, and if you're making, let's look at 2015, for instance, and look at the example of married filing a joint tax return. What this says, if you're making less than $183,000, you're eligible for the full contribution. If you're making between that, you might be eligible for a partial contribution on a Roth. Anything over you're not eligible to set up a Roth IRA. But again, please talk to your tax advisor to fully understand if you are eligible to contribute to a Roth IRA based on your modified adjusted gross income. Traditional IRAs, who is eligible to set one up? It's really very simple. You must be the age of 70 and a half or less. Anybody over the age of 70 and a half may not contribute to a traditional IRA, and you must have earned income. You may contribute 100% of your earned income, and we will discuss what is earned income in a couple of other slides, up to the limit. And typically the limits are $5,500 if you're under the age of 50, or $6,500 if you're over the age of 50. So as long as you're under the age of 70 and a half, you're able to, and you have earned income, you're eligible to contribute and set up a traditional IRA. So in terms of spousal contributions, we talked about that again. Take advantage of that. If you are married and you're filing joint tax return and your spouse, husband or wife is not working, they can still set up their own IRA and call the spousal IRA and make contributions to themselves as well. Depending on their age, they can put away up to $5,500 or $6,500 there. Here's a look at the, again, we always say, first of all, in a Roth IRA, contributions are not deductible. In terms of traditional IRAs, it's going to depend, and we always say it may be deductible. Please talk to your CPA or tax advisor on this. But it really boils down to the table down there and where is your adjusted gross income? What are the limits? So, traditional contributions may be deductible, but it may be limited if you or your spouse are covered also by a retirement plan at work and your income exceeds certain levels. So, for instance, if you're married, an active participant filing a joint tax return in 2015 and you're making over $118,000, then you cannot deduct any of your contributions for your IRA. But again, talk to your CPA to make sure you are aware of what your contribution limits are and your deductibility factors are. Contribution limits for Roth and traditional IRAs are the same. Again, nothing has changed for 2015 and 2016. If you're up to age 50, you can contribute $5,500. 100% of your earned income up to $5,500. So, for instance, if you just made $4,000 for 2015, you can contribute $4,000. If you made $100,000, you can contribute $5,500. They have what we call a catch-up contribution for if you're over the age of 50, an additional $1,000. So the total contributions if you're over the age of 50 is $6,500 for 2015. And nothing has changed for 2016. It's still the same, $5,500 and $6,500. Taxable compensation. What is deemed earned income? Many times the question arises, what determines if the compensation is taxable, if it's earned income or not? Snapshot here, what is and what is not, but please make sure you talk to your CPA to make sure if it's eligible or not. But what is considered, generally speaking, taxable compensation? Obviously, wages, salaries, tips, etc. is. Professional fees, commissions and bonuses, self-employment income, 1099s, alimony and separate maintenance, military differential pay, non-taxable compat pay. These are all considered taxable compensation and can be included as part of your earned income to determine what your contributions are for the year. What is not considered taxable compensation are, among others, earnings and profits from property, interest and dividend incomes that you get from partnership investments that you make, pensions or annuity income, deferred compensation, again, income from certain partnerships, self-employment loss. All of those are not considered taxable compensation when you're looking to figure out what your earned income is for the year. Contribution timing, when can I make my contribution for the year? Again, during tax year, up until the payer's tax return due date, not including extensions. So for instance, in the year of 2015, you have up until, remember this year is extended till April 18th, up until April 18th of 2016 to make your 2015 contribution. So the time frame is between January 1st of 2015 to April 18th of 2016 for the 2015 contribution. The taxpayer must designate the tax year of the contribution. For instance, now starting January 1st of 2016, you may make contributions for 2015 and or 2016. So when you're making your contribution, you need to please designate which tax year it's for. Otherwise, us as a trustee, we're required to post for the current year if we're not notified. So if you send us a check, $5,500, Munzer, please post make contribution for the year, I'm going to assume it's for the current year. Okay? So contributions basics. Let's go through these real quick. An annual contribution is the deposit, again, of personal funds into the IRA in the form of cash, nothing else. Could be remitted by check, wire, or ACH direct deposit. We can't take actual cash dollars. So it's either made in check, wire, or ACH. The tax code limits the dollar amount you can contribute each year. Again, we talked about $5,500 if you're under 50, $6,500 if you're over 50. Maybe increased due to cost of living allowance adjustments, COLA. This year, the IRS made the announcements for 2016. It has not been increased. It's still the same for 2016. Contributions for tax year 2015 must be postmarked on or before April 18th, which was, again, the deadline has been extended to the 18th of this year. So we don't really have to have the check in our possession, but the contribution, if mailed, has to be postmarked on or before April 18th, or obviously wired or ACH into your account on or before April 18th. Once the contribution is made, your custodian or administrator or trustee, such as Entrust, we're the administrator here, we submit the IRS Form 5498 to the IRS, showing what you've made as far as the contribution and for what year and etc. So in summary here, before I open it up to some questions, the individual's tax year 2015 tax return, again, deadline is April 18th for this year, which is the deadline to make an IRA contribution as well. We talked about how to maximize your tax refund, talked about the few options, the flexible savings account, put away some money in an HSA if you have a high deductibility medical insurance at work, maximize your contributions to the limits, you know what your limits are and maximize those contributions, know your tax brackets, better understand how much you can contribute, and so on. So before I open up some questions, I wanted to to go through our 3 steps needed, to self-direct your retirement plan and to show you how simple and easy the process is. Remember what we talked about at the inception, that we are merely administrators. We are order takers. We work with individuals and small business owners that want to invest in alternative investments when it comes to their IRAs. So they come to us with an investment in mind, right? So the first step to do so is open up an account with us. It's really very simple. Complete a couple of documents for us. The account is established within 24 hours. Second step would be, and I think usually that is kind of the step that takes the longest, because it's really out of our control in the sense that we are waiting for your funds to be transferred from your current IRA trustee or rolled over from your previous 401k, and we're really at their mercy however long it takes them, typically about 2 weeks. So you fund your account, whether it's a transfer from an IRA, another IRA at Schwab, Fidelity, Vanguard, wherever, or you roll over from your previous 401k administrator, Or, as we discussed, even make your contributions for your IRA. If you're looking to self-direct small amounts, you can start up a new IRA, self-directed IRA. Again, a self-directed IRA is a term used in the industry. It's not a type of IRA. It's a term used in the industry for an IRA that allows you to invest in those alternative investments. So, if you're eligible for a Roth, you can set up one with Entrust. It's self-directed. If you want to set up a traditional, you have earned income and you're under the age of 70 and a half, then you can set up a traditional IRA that is self-directed at Entrust. Thirdly, you purchase your asset. You select, you identify the investment you want to make, whether it's a piece of property, whether it's buying membership interest in an LLC or a private placement or a limited partnership. We send you the certain paperwork needed. We require certain supporting documents. We turn around and fund your investment in about a day or two. So we always say from A to Z, the process of setting up an account to turning around and funding your investment is about 2 to 3 weeks. So that's really how simple it is. One thing I want to mention real quick before we get to our questions is to take advantage of, we're running a special and promotional offer to all our new clients out there that are looking to set up an IRA and transfer or roll over their current retirement plan, whether it's in an IRA or a previous 401k, to Entrust to self-direct. If you do that, we will, through the tax deadline, which is April 18th, waive your establishment fee of $50. Typically, we have an establishment fee of $50 to set up an account. If you submit your paperwork along with your transfer paperwork or rollover instructions to fund your Entrust account, we will waive that $50 establishment fee for you. For more information about that, please visit our website or call me or call my office with any questions. I'll put the slide where my information is right here. I am based in Santa Monica in LA. You can also reach me if you are in the area. I'd love to meet with you. I also have another office in Orange County if you'd like to meet there. Happy to meet with you as well in person. Feel free to call me at 310-496-4216, or you'll see my email right there. If you happen to be in other areas in our country, please visit our website for the closest office to you. We have our main office up in the Bay Area. We have an office in St. Louis. We have an office in New Jersey, one in Texas, Austin, Texas, and one in North Carolina. Again, to better serve our clients and provide them with the best customer service possible. So that concludes my webinar for today.